So welcome to our class tonight. And tonight we're going to be talking about two chapters. We'll do the discussion for chapter 12 and chapter 13. Both are fairly short chapters, so getting them in together, no problem. We will also be covering the homework from chapter 11, and there is not much homework to cover. Then next week, we're going to cover the material in the chapter 24 outline, in that discussion outline. And also in chapter 25, I'll have a few other topics for you then. Outside of that, I'll have a bonus video for you, which covers some topics which are on the syllabus, which I will not test you on. Just watch that at your own pace, even after the end of the semester is fine. So again, your testing on this material will just be through the material we cover next week. I will also make sure that we cover the homework on that material for next week, so they are all up to speed. So tonight, what I would like to do is to go ahead and cover the chapter 12 discussion first. And chapter 12 is going to continue this theme of internal control. Then chapter 13 is going to be largely a review chapter. And as I said, these chapters are fairly short, so no problem in discussing them both here tonight. So with that in mind, let me turn to the chapter 12 outline. I'm going to be sharing my screen here with you. As always tonight, whenever you have a question or comment or anything, you just let me know. Sometimes I'm not as good about watching chat as I should. So if you put something in the chat and I didn't see it, feel free to just say, hey, I put something in the chat. So here in chapter 12, again, continuing internal control, it's about assessing control risk and reporting on internal control. So we're going to be seeing how the auditor goes about making sure that he or she assesses control risk. In other words, the risk that an account has a material error in it, assuming no internal control. I'm sorry, I just gave the definition for inherent risk. Whoops. Control risk is the risk that internal control does not prevent and or detect a material error in an account. So if internal control is good, control risk is low. And quite frankly, the account is less likely to have material errors in it. So we will have to gather less audit evidence because internal control has done its job. Things are probably okay. But on the other hand, if control risk is high, it means internal control is not working. So in that case, the account probably has material errors in it. We have to gather a lot of evidence in the audit. So we'll see that here at play. So let's talk about, first of all, how we study and evaluate internal control. And in the book, figure 1211 on page 399 or 391 depicts this. But you may like my verbal description more. So let me go ahead and flash up here on the screen. Whoops. Way. This figure here, I think it's a little bit confusing. So if it helps, so be it. If not, just rely on what I've got in my notes. Now, reading on, you'll see that my description concerns non-issuers. In other words, privately held clients. So we'll talk about them. But remember, the auditors of issuers or publicly traded clients perform additional work in order to issue what's called a 404 report about internal control. We've seen that before, and it gives an opinion about internal control. Is it working okay or not? So auditors of issuers are going to perform the same work we're going to talk about here tonight, except they do more of it. So shall we say more in depth, and they do that to issue the 404 report. So what we talk about here applies to issuers as well. But again, if we audit them, we just do more of this and issue that 404 report with our opinion. We'll talk more about that at the end. So let's talk about the nuts and bolts of how we go about doing this. So in B, the auditor first has to obtain an understanding of the internal control design and operation. So we're going to be overviewing things, and doing so will conduct a preliminary understanding of the client's internal control structure through conducting procedures to obtain an understanding of internal control. We've talked about these before, way back in the course, and we're talking about things here that are quick and easy to do for the most part to get acquainted with internal control. We do these pretty early in the audit because we want to know how good internal control is or how bad it is, at least on a preliminary basis. And then we'll get into more of the nuts and bolts of internal control if we decide to adjust a bit. So looking at these procedures to obtain an understanding of internal control, what kinds of things do we do? Well, we'll have inquiry of client personnel. So we'll ask people, for example, how do you go about doing your job? How do you approve credit? Do you ever let anything slip by? Let's hope they're honest. Also, a review of the client's policies and procedures manual to see how good it is or how bad it is. For example, their credit approval process for sales. Does it look good in there, or are there problems with it? Maybe they need to spruce things up. We'll also observe activities. So let's observe people in doing their jobs. Are they following internal control or not? For example, if we have segregation of duties, different people doing different things, are truly different people doing these duties? If we observe the same person handling cash and keeping records for cash, for example, that's custody of cash plus record keeping, that's a no-no, even though they may say they're separate in the policies and procedures manual. And we'll also inspect documents. For example, with credit approval of sales, going back to that, if we do not see a credit approval number for every sale that's made, that's a bad sign. We inspected those documents and, well, internal control is not being followed. And that means, by the way, that we're going to expect a lot more bad debts in that case. So how can we document this understanding? And of course, the mantra is document, document, document. Well, we can document that in flowcharts. And if you've had AIS, you've done those. And just to let you know about the others, they're in your book. I won't test you on them. Narratives or internal control matrices, internal control questionnaires. You can have a look at these if you would like. But the internal control questionnaire is in a pre-prepared format, and the client can help complete it. So we'll ask about internal control. How do you go about it? What kinds of policies and procedures do you have? What kinds of software do you have, etc. Hopefully we get honest answers, and usually we do. We can always verify anything in there. So the auditor is going to be concerned with identifying specific controls and weaknesses. So a specific control which is in place, such as that, again, of approving credit sales, or are there any weaknesses in that? Are there any ways in which it could be improved? And a weakness could either be a lack of a needed control, and that's related to the design of internal control, or when an existing control is not working, which is related to the operation of internal control. For example, an internal control may be on the books, which says that employees will not trade passwords. However, if we go out on the floor, we see that employees are trading passwords all the time. So they're using each other's password. That's a no-no. So the design of internal control in that case is okay. It looks good on the books, but the operation of internal control is not okay because, again, employees are trading passwords. And finally, the auditor is also going to identify the related misstatements which could occur. So again, with not approving credit sales, if we find that, well, it may say on the books that employees will approve every credit sale. We go out on the floor and we find they're not doing so. So if, again, the design of internal control is good there, it says they will approve credit sales, but the operation is not okay. In practicality and operation, the employees do not approve credit sales all the time. Well, that's a problem. It means more bad debts. That's a misstatement that could occur. Now in number 2, the auditor is going to assess a preliminary value for control risk. So is it high, is it low? And again, very preliminary. We're going to back that up with more specific tests called tests and controls. We'll see them in a bit. So a preliminary value for control risk as a result of his or her preliminary understanding of internal control. And we'll remember that maximum value for control risk is 1 or 100%. So in other words, we assess 100% chance the material error is not prevented or detected by internal control. That's the maximum. Now, if the auditors decide upon a preliminary value of control risk below 100%, must corroborate that through test controls. We'll see them below, and then we'll decide upon a final value for control risk. Yes, indeed, we could decide upon the maximum value of 100% at this point. Internal control is too bad to rely on, and I will show you that in operation in just a little bit. But usually we decide on something below 100%. Now, number 3, the auditor's preliminary understanding of internal control is going to be a lot quicker to do if he or she's previously audited the client. At least if there have been no major changes in internal control. And the preliminary understanding will focus on updating the auditor's knowledge. So we're already pretty familiar with how this client does operations. And we're familiar with their internal control. We can probably go through and do our job much more quickly. That's a nice benefit to a continuing client, and also a reason why clients sometimes hire auditors. Well, now in C, we have a little decision to make. The auditor is going to assess whether internal control is sufficient to allow the financial statements to be audited. And the answer is yes to almost every case, but if not, the auditor is either going to withdraw or disclaim an opinion because that's the scope limitation. That would happen on very, very rare occasions. So just know it does exist, but I would argue that that is a poor judgment in accepting this client. We shouldn't have even accepted them. Now in D, recall that I said we might decide upon a final value, a preliminary value of control risk as 100% or something less. So let's talk about those here in D. So first, if the auditors decide upon a control risk of 100%, this preliminary assessment, he or she is going to omit test controls, instead perform expanded substantive tests, especially tests of details. I will show you. Now, a couple of reasons for this. He or she may have decided upon a control risk of 100% because internal control is not effective. In other words, internal control is too bad to rely on to prevent and or detect misstatements, so the accounts may be materially misstated. I think that's probably the most obvious reason there in number 1. This client has poor internal control, and we're just going to have to audit around that. So maximum substantive tests in that case. Or in number 2, this was less obvious. The auditor may have also set a control risk of 100% because the cost of conducting test controls exceed the expected decrease in substantive tests, which may result, even though internal control appears to be effective. And the latter is the case for many small clients, for example. So for a small client, instead of bothering with their, rather basic internal control, we might decide to audit around that and officially declare control risk as 100%. So in other words, instead of bothering trying to assess their basic internal control any further, we'll just do a full-blown substantive audit. For example, they probably deal with only one bank, so we can confirm any cash with that bank. More about that in the second auditing course. They probably have very few accounts receivable, if any. In fact, if they're using external credit cards, they have none. So an external credit card is just like cash, basically. You will get an EFT or electronic funds transfer of your sales, and you don't have to keep accounts receivable. So we can confirm any small accounts receivable they have. They probably don't have many, if any. With inventory, they probably don't have a lot. We can count it all, etc. So it may be cheaper just to do that full-blown substantive audit, as we often call it. Now, reading on, if the client has extensive electronic evidence, though, that might not be possible because the auditor needs to audit through IT. For a small client, that generally doesn't happen. Now, also, that's not possible for an issuer because the SEC requires a 404 report, so we must do test controls in that case. We'll discuss some more later. But a small client will not be an issuer. They will be privately held. So that point is moot. And then number 3, we can note that even if control risk is 100% because internal control is bad, well, the auditor can still issue a clean opinion if the client corrects any resulting material misstatements. So yes, indeed, a client can have very, very poor internal control, can have control risk of 100%, but they fix anything that's wrong. That's okay. We can still give them a clean audit report. But it was a big fight to get there, and it's going to be a rather costly audit. But as long as they correct everything, they're good to go. Now, the second case, let's say that auditor decided upon a control risk of less than 100%. So he or she must conduct test controls in order to document a final value of control risk. And there are 4 possible test controls: inquiries of appropriate client personnel, examination of documents, records, and reports, a type documentation, observation of control-related activities, and reperformance of internal control-related procedures, including walking through individual transactions. It's also a good way to obtain an understanding of the internal control system. And even though it's in Chapter 13, there's a table that illustrates some test controls. Basically, I just want to say that once you know the control, you can easily formulate how to test it. For example, is credit approved for credit sales? Once again, we simply pull a sample of sales documents, that's documentation, and look for a credit approval number on each one. So it will not be difficult to formulate test control. We will do that in the second auditing course, but not really in this one. But just wanted to give you an example of that. Another thing that I wanted to say with walkthroughs, that is a way in which we take an individual account or something, a subset of that, and reperform everything that was done in it. A very good example would be for student accounts here of Florida Southern. Our auditors take a sample of individual student financial aid accounts, usually a sample of about 100 or so, sometimes more, and they walk through every single transaction that occurred, making sure internal control is followed each place along the way. For example, that if you have a credit balance on your account that is refunded within, I think, 30 days, and that's a federal requirement. So they really walk through extensively, making sure internal control was followed every single step along the way. Now, number 2, the extent of test controls may be affected by last year's audit and by whether the auditor is able to test the entire audit period. Again, if we did the audit last year, we pretty much know about internal control. We're just going to be updating our knowledge. And testing the entire audit period, let's hope we can. If we cannot test the entire audit period, that's likely to be a scope limitation. Not good. And number 3, practically the assessed level of control risk gets lower. Often the auditor must perform more test controls. Basically, the lower control risk is, the more we must prove that point. Now, NF, time to set a final value of control risk. We see the auditor can do that once they've completed test controls. And if internal control is effective, then that final value of control risk will be less than 100%, and substantive tests can be reduced. Again, the lower that control risk is, the fewer substantive tests we've got to do because probably the account balances are fairly stated. So that's because there's some assurance the accounts are fairly stated, but control risk will be 1 or 100%, of course, if test controls show internal control is not effective. And the auditor would then expand substantive tests. So the higher control risk is, the more substantive tests we've got to do. Now, G, we've seen this in the past. We can remember the test controls are often performed at the same time as substantive tests and transactions. And that's called dual purpose testing. So for example, as we're looking for a credit approval number for each sale, we might also trace that sale to the sales journal and make sure it was recorded properly. So in looking for the credit approval number, that is the test control, and tracing it to the sales journal, that is the substantive test of transactions, because in that case, we are comparing dollar amounts. Anything having to do with the dollar amount is a substantive test. So that's a dual purpose test, and quite frankly, we often do a dual purpose test because while we have this sample of sales transactions pulled, let's kill two birds with one stone. Then in H, we always remember that unless we conduct test controls, we must set control risk at 100%. That was obvious earlier. And also, as we said, we'll therefore conduct the maximum amount of substantive tests. And again, that would be appropriate for a client whose internal control is too bad to rely on, or for clients where we decide the cost of test controls would not be offset rather by the reduction in substantive tests. Again, that's that small client. So if control risk is 100%, you can bet it's either because internal control was too bad to rely on, or we have a small client with basic internal control. You know, maybe for that small client with basic internal control, that basic internal control is okay. But again, why bother testing it? Just skip right toward a full-blown substantive audit. So let's say that we find something wrong. Well, let's see how we're going to deal with that next. So if we find something wrong with internal control, we've got to categorize that as either a deficiency, a significant deficiency, or a material weakness. So let's see what we've got to do. Well, we'll identify the existing controls. In other words, what is on the books? What is in the policies and procedures manual? So are they okay or not? If they have some problems, we'll think about that. So thinking about that, number two, we'll identify the absence of key controls which are needed. They don't have a proper internal control that they need on the books. For example, they did not properly segregate duties, and they did not identify the duties which should be separate in the policies and procedures manual. Then number three, we'll consider the possibility of compensating controls. So a compensating control means, well, at first blush, it looked like we had an internal control problem, but we don't in the end, because another control is going to compensate for it. I will talk about an important one in a few minutes, which is the owner's involvement in a small business. Owner's going to be very motivated to make sure things go okay. Well, then, if we still find a problem with internal control, we'll identify that again as a deficiency, significant deficiency, or material weakness. So what's the difference between these? Well, first of all, a deficiency exists if the design that refers to what's on the books, how internal controls design the policies and procedures manual, or the operation of controls. Operation refers to how controls are carried out on a day-to-day basis. So if one of these does not permit company personnel to prevent or detect misstatements on a timely basis. So a deficiency in the design would be where the business does not have proper credit approval procedures in the policies and procedures manual for credit sales. A deficiency in the operation controls would be, once again, if the control is properly in the policies and procedures manual, but the personnel just don't follow it on a day-to-day basis in their day-to-day operations. So deficiency, again, could either be design or operations in nature. Now, if things get worse in the second Roman numeral 2, well, Roman numeral 2 here, a significant deficiency is a deficiency or a combination of deficiencies in internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance. So it's worse, and the auditor feels they need to bring it out to those charged with governance. For example, the audit committee. I will show you how they do so in just a moment. But now let's say things get worse. We've got little Roman numeral 3, a material weakness. It's a deficiency or a combination of deficiencies in internal control such that there's a reasonable possibility the material misstatement of the entity's financials will not be prevented or detected and corrected on a timely basis. So material weakness, it's the auditor's judgment as far as whether something's a material weakness or not. If the auditor feels it is, well, it bumps up to this worst case category. And we will definitely bring that to, again, those charged with governance. So how do we do that? Whoops, this says little Roman numeral 3 once again. It should be little Roman numeral 4. But both significant deficiencies and material weaknesses must be reported in writing to management and to those charged with governance in the company. So for example, at Florida Southern, as our auditors find problems, they do report those to President Kerr. They also report those to the audit committee. We've had very few problems with internal control, fortunately. But there's a letter in the book to communicate significant deficiencies and material weaknesses. I will show you in the book in just a second. But deficiencies that are less than significant may be reported in the management letter. The management letter we will see in chapter 24 is a letter of simply suggestions made by the auditor, and they send that letter to the client. So don't worry about that yet. But on page 383, oh, also I should say number 5, we'll also determine potential misstatements which could occur if we find a problem. For example, a problem with credit approval, we will say that one misstatement that could occur would be more bad debts. All right, so let me actually just stop here for a moment and check in here with you. And does anybody have any questions so far? Everything going okay? All righty. Anytime, again, you need me to stop or you have a question, you just let me know. Anytime you want me to stop sharing my screen and come back on screen live, again, you let me know. So let me go sharing my screen again. And I'm going to come to the book and show you this letter, which again is on page 383. So here we have something, letter regarding significant deficiencies in internal control. It's this letter that I'm talking about, and we would get a very similar one to our audit committee at Florida Southern if we had problems. So this one here, by the way, this letter is written using a template from PPC audit software. They don't tell us that in the book, but that's the software they tend to use. Very common audit software. And in that, within that software package, you can access a template for this letter and simply customize it to your client. And they did that here. So they're of the supposed firm of Johnson & C. Graves, CPAs, up in Troy, Michigan, just outside of Detroit. Troy, by the way, having a very large Polish population. I remember eating a couple of very good Polish restaurants there. So this is going to their client, the Airtight Machine Company, again up in Troy. Oh, by the way, I used to have a neighbor who was named Troy. I guess where he was from. Troy, Michigan. Used to have a student named Cody who was from Cody, Wyoming. Had several Brandons from Brandon. On it goes. So let's see what this says. There is no standard language in one of these, but the language we see in here is very, very common in these letters. And most of it is going to be very familiar to us. As a good review for some things we've seen. So let me walk you through this letter. Take just a couple of minutes to do it and see what's in here. So in planning and performing our audit of the financial statements of Airtight Machine Company, as of and for the year ended December 31st, in accordance with auditing standards generally accepted in the United States of America, that sounds familiar, we considered Airtight Machine Company's internal control over financial reporting, or we just call it internal control, as a basis for designing audit procedures that are appropriate in the circumstances for the purpose of expressing our opinion on the financial statements, but not for the purpose of expressing an opinion on the effectiveness of Airtight Machine Company's internal control. Accordingly, we do not express an opinion on the effectiveness of the company's internal control. So they're saying right there that this is a privately held company. If we're a publicly held one, they would express this opinion in the 404 report. Well then, our consideration of internal control was for the limited purpose described in the preceding paragraph and was not designed to identify all deficiencies in internal control that might be significant deficiencies or material weaknesses. So in other words, we may not find everything, and we're just warning you about that. So just happens we did find something. So however it's discussed below, we identified certain deficiencies in internal control that we consider to be significant deficiencies. So we've got something here that's wrong and we need to let you know. And then they define what are deficiencies. So a deficiency in internal control exists when the design or operation of a control does not allow management or employees in the normal course of performing their assigned functions to prevent or detect and correct misstatements on a timely basis. A significant deficiency, so when it gets worse, is control deficiency or combination of control deficiencies that adversely affects the entity's ability to initiate, authorize, record, process, or report financial data reliably in accordance with general accepted accounting principles. That is less severe than material weakness, yet important enough to merit attention by those charged with governance, again, like the audit committee and senior management. And we consider the following deficiency to be a significant deficiency in internal control. So it's not a material weakness, but it is a significant deficiency. It's on that level of urgency, and we're informing you of it. So here it is. There's a lack of independent verification of the key entry of the customer's name, product number, quantity shipped, prices used, and the related mathematical invoices on mathematical extensions, on sales invoices and credit memos. By the way, a mathematical extension simply refers to quantity times price. So for example, 2 items at $10 each would have an extension of $20. So nobody is checking over this data entry clerk's work. It's a data entry clerk who's doing this. You can read between the lines here, I think. And nobody is observing his or her work. Nobody is going back and checking his or her work either. So unfortunately, well, we have a loose end here. So as a consequence, errors in these activities could occur and remain uncorrected, adversely affecting both recorded net sales and accounts receivable. And this deficiency is significant because of the large size of the average sale of airtight machine company. So again, nobody is going back over within the company and doing internal verification to make sure that this data entry clerk is doing that person's job. Well, the data entry clerk, quite frankly, is not paid a lot per hour. They don't have a lot of knowledge of accounting. So we need someone to check the work. Plus, we always need someone to check work or internally verify because it's very difficult to find errors in your own work. And then we see this communication is intended solely for the information use and management of the board of directors. And is not intended to be and should not be used by anyone other than these specified parties. So we restrict distribution of this. That's normally done. So that's an example of a letter there. And again, let me just come back to live here for a second and see, does anybody have any questions about that? Do things sound familiar in that? All righty. So I'll go back to sharing my screen. And I will come back here to the notes themselves. Now, way back in chapter 3, and also a couple of other times, we referred to the auditor's 404 report. I will not have you write one of these. I want you to know what it is, and I want you to know it has an opinion about internal control. It is for a publicly traded client. It gets its name because of Section 404 of the Sarbanes-Oxley Act. That's where these originated. They were for clients whose fiscal year ends ended after the end of November 2005. So there was a phase-in period with the Sarbanes-Oxley Act. And then Sarbanes-Oxley said, for a publicly traded client, they must have an opinion about their internal control, in addition to the opinion about their financial statements. So that meant that the cost of the audit went way, way, way up at that time. So a few things about that 404 report. Again, required for SEC clients or publicly traded ones, also known as issuers. It's going to include this. So the auditor's opinion as to whether the company maintained in all material respects effective internal control over financial reporting as of the specified date. So do things look okay or not? And Public Company Accounting Oversight Board Standard 5 requires reporting all material weaknesses and significant deficiencies. So just like general accepted auditing standards, the Public Companies Accounting Oversight Board, which we briefly mentioned during the course, don't worry about it, does have its own set of standards, but they're, quite frankly, much like general accepted auditing standards. So this standard 5 says you've got to do the same thing as in general accepted auditing standards. And for those charged with governance, you've got to report material weaknesses and significant deficiencies. So once again, just like for a privately held client under general accepted auditing standards, this means that the audit need not be designed to detect deficiencies in internal control, which are individually or in the aggregate. That means in total, less severe than material weakness. So you don't have to worry about material weaknesses here. And to let you know, the 404 report may have an unqualified opinion. That's what everybody wants, almost everybody gets. Or it could be a qualified opinion. So here's something that is wrong. Or it could be a disclaimer of opinion. In that case, we could examine everything we wanted to about internal control. Again, just like in an audit report about the financial statements. Or it could be an adverse opinion. In other words, we think internal control is not working at all. I've only been aware of one adverse opinion, and that was several years ago for General Motors. It was right after it emerged from federal government receivership as the government was trying to save General Motors, which by and large they did, but it had an adverse opinion. And General Motors countered that by saying this. They said, essentially, what do you expect? We just emerged from federal leadership, federal receivership, federal protection. And we were referred to as government motors at that time. So from the federal government, well, that's as good as it gets with internal control. So they sort of just brush that off. Now, finally here to let you know, those last few pages of the chapter contain some information about information technology. That's covered in AIS. So I'm not going to worry about those pages there and the material on them. So as I said, chapter 12, not a long chapter, not bad whatsoever. And what questions do you have on it? Okay. Let me just go ahead and while I'm on screen, I'm going to pull up chapter 13. So chapter 12, again, seemed pretty understandable. Okay, if not, you just let me know. Chapter 13, I think, will be quite understandable as well. So for chapter 13, it's largely a review chapter, as I've said before. We're going to be reviewing the different types of audit tests we have. We're going to see how those tests fit together in something called the audit program, the list of things we're going to do in the audit. And you'll see why we may emphasize one type of test more than another test. So with that in mind, let me go ahead and start sharing my screen once again. And we'll look here at chapter 13 notes. So this file is on Canvas, I told you in the email, and I also sent you a copy of it. So just wanted to make sure that you had it there. So overall audit planning. So first thing I do here is to review the types of audit tests we have. And the first type that we usually do very early in the audit, analytical procedures. We covered them way back in chapter 8. So with analytical procedures, generally quick and easy tests we do, such as we will run a set of financial ratios up front and compare these to the client in time series, so across time, and we look for sudden changes that we would not expect, or we could compare these cross-sectionally to the client's industry and make sure that the client overall looks like its industry. If we see unexpected differences, that's where we stop and think, well, maybe something's wrong. So we like to do that very early in the audit. Well, then B. Another type of audit test we do, procedures to obtain an understanding of internal control. So we covered these just a little bit ago. In fact, in chapter, that should be chapter 12. Let me change that there. And we saw there to obtain an understanding of the controls and to determine whether they've been put in place. So again, we do these very early in the audit so we know how good or how bad internal control may be. And these will allow the auditor to assess a preliminary value for control risk, as we know. Is it 100% or is it something less? If it's 100%, we will skip the next thing and see test controls. So if it's 100%, don't worry about those. But something less than 100%, we must do these. So test controls, what are they? Well, we also cover them in chapter 12. Sorry for those typos there. And they're to assess a final value of control risk and may be lowered from the default value of 100%, thereby reducing substantive tests, especially tests of details, and that's good. They're usually relatively expensive. And I'll discuss more about the costs of different types of audit tests in a bit. So we hope through test controls we can reduce the amount of substantive testing we've got to do. For example, confirm fewer accounts receivable. And test controls will test the effectiveness of the controls. You can always tell when you have a test control because it will be talking about that control, but not about monetary amounts. It's simply making sure the control is followed. Well, then D, another type of test we've seen, substantive tests of transactions. And they're tests for monetary errors. Could be unintentional errors or could be fraud affecting individual transactions. So for example, as we trace those sales transactions to the sales journal, we make sure there are no posting errors. We're talking about substantive tests of transactions there. The term substantive is there because we are dealing with monetary amounts. So you always know if you have a substantive test of transaction because it is affecting the monetary amount of an individual transaction. And these will reduce tests of details if the results are good. Tests of details again pertain to the ending balance of an account, especially a real account. They get expensive. So I'll show you that in a second. Now, we've also seen that substantive tests of transactions may be combined with test controls, the dual purpose test. So that way we're testing the control and testing the dollar amount of the transaction in one fell swoop. And the text often refers to both substantive tests of transactions and test controls as test transactions. Again, we've seen that. It's because we're testing one transaction at a time. And then E, the fifth and final test, tests of details of account balances. And we know those are to substantiate the ending balance of an account, especially the real or balance sheet accounts. We're trying to make sure that the ending balance is okay. So if we confirm an account receivable with a customer, we ask the customer, is this your correct balance or not? That is a test of detail. Well, we know that it's important to perform both substantive test transactions and test of details due to double entry accounting, as well as to the carryover of the real account balances to the next fiscal year. The auditor wants next fiscal year's beginning balance to be quite accurate. An example of that would be that we would test individual credit sales within accounts receivable, of course. That would be through substantive tests of transactions. That's important. But it's also important that we at least take a sample of those accounts receivable and test the ending balances. We would do so through sampling, and we would pick a sample of customers to confirm their accounts receivable with them. Again, more about that in the second auditing course. Of course, as we audit accounts, we are very mindful that the ending account balance will be next year's beginning balance. So we want the ending account balance to be quite accurate, frankly. For example, with cash, we want the ending cash balance to be very accurate. This way, it rolls over in next year. We don't have problems with it as we do next year's audit. And And by the way, there are no tests of details for most nominal accounts because their balances are closed out to the real accounts at fiscal year end. So for example, the sales revenue account, there is no test of detail for it because it's simply a means of adding up individual sales transactions. So instead, we would test those individual sales transactions through substantive tests of transactions. So the sales revenue account itself does not have a test of detail for it, but accounts receivable will. Now finally, that figure 13.2, if that helps you, so be it. If not, that's okay. Same thing with F, figure 13.2. Now in G, I mentioned cost of tests a little bit ago. Well, increasing costs of tests. In other words, from lowest to highest. Cheapest, definitely analytical procedures. Things like financial ratios, cheap and easy to do, quick, time is money. Even Excel can do common financial ratios for us if we upload a company's financial statements to it. Then, well, it takes some more time, so more expensive. It's kind of a tie between test controls and procedures to obtain an understanding of internal control. What does cost more? Number 3, substantive tests of transactions. For example, with a test control, like looking for a credit approval number on a sales transaction, that's quick and easy. What does take more time would be the substantive test of each sales transaction. For example, reperforming the math and tracing that transaction to its posting in the sales journal. And then the most expensive still, tests of details. For example, sending out, tests of details, number 4. So sending out confirmations to customers, that can get very expensive. Got to follow up on them, and trust me, a lot of time there, so expense. Now that's a general guide because it can vary according to account or client. And we can note the more precise information is generally provided by the more expensive tests. Just like anything else in life, you get what you pay for. So in confirming accounts receivable, we get very accurate information for the most part. In confirming cash with the bank, which again we'll see in the second auditing course, we get very accurate information, but it costs money to get it. So the more accurate it is, the more precise it is, generally the more expensive it was to get. So let me come back live on screen before I go to H. So let me just ask, do you all have any questions? Anything I can help with? Oops. All right, let me go ahead back and share my screen. I'd like for us to look at H, variation in audit plans. And we're going to go over table 13.3 on page 418, and we'll make sense of the mix of evidence to be gathered for these 4 clients. So page 418 here, let me get that up on my screen. There we go. So we've got here 4 clients, and we've got 4 of the 5 types of audit tests. Test controls, they didn't list procedures to obtain an understanding of internal control, but that's okay. Test controls, substantive tests of transactions. Analytical procedures, they said substantive, that is redundant. Analytical procedures are always substantive because they're dealing with dollar amounts. And then tests of details. So for these 4 clients, do we do E, extensive amounts of these, M, medium amounts, S, small amounts, or N, none? Let's look at all at one. They did extensive test controls. They must have felt that their preliminary value of control risk was way below 100%. So they tested internal control very extensively. Then, small amount of substantive tests of transactions. By the way, let me skip over small amount of tests of details. Well, let's look at analytical procedures. They did extensive amounts of those. So here's what Audit 1 did. That auditor went in and thought, this is a good client. They've got control risk of well below 100%. We'll say that on a preliminary basis. So we test controls very, very thoroughly. With analytical procedures, we did extensive ones. Again, we think that they're a good client, so we can do more of these cheaper tests. We did, and we got good results. So we didn't have to do as many of the other tests. We did a small amount of substantive tests of transactions, a small amount of tests of details of balances, because we felt this client was a good one, and sure enough, they were. Their good internal control prevented misstatements in their accounts. So that's good. We relied on internal control. We relied on analytical procedures. And that was good evidence that their accounts were fairly stated in most cases. So All at One is a good client. The cost is relatively less because we did more of the cheaper tests and fewer of the more extensive tests. So any questions there about All at One? Or does that audit make sense? Okay. Then All at Two. It's not quite as good a client. They did medium test controls. They must have felt that while control risk on preliminary basis was less than 100%, it wasn't as low as an All at One. So not as good a client. Skipping over to analytical procedures, they did extensive amounts of these. Okay, they did more of the cheaper tests, that's okay. Now, how did test controls and analytical procedures turn out? My guess is not nearly as good as an All at One, but not terrible either. So All at Two, this client, their accounts are probably fairly stated, although we're not as certain about that as an All at One. Because again, test controls didn't turn out as well, I think, in All at Two. Neither did analytical procedures. So that's why we increased the amount of substantive tests of transactions to a medium level, and the same thing with tests of details. So with All at Two, it's not as good an audit client, but not a terrible one once again either. But in All at Two, you can see that we did more of the more expensive tests and somewhat fewer of the cheaper tests of details. So All at Two is a more expensive audit than All at One, although again, not terrible. Now All at Three. They did no test controls. Automatically, that means control risk is 100%. As we went in and had that preliminary judgment about control risk, yes, it is 100%. Automatically. Looking at analytical procedures, they did not do as many of them, only a medium basis. So they figured in this case that since control risk is 100%, we're going to have to do the maximum substantive tests of transactions, extensive. The maximum amount of tests of details, extensive. So why bother doing a lot of analytical procedures either? So they did a very thorough set of substantive testing here. And since they did, well, that means All at Three, probably not as good a client, certainly, is an All at One or All at Two. So All at Three is also a more expensive client because they did none of the cheaper test controls and they did extensive amounts of the more expensive substantive tests of transactions and tests of details. Again, fewer of the cheaper tests of analytical procedures. So these audits keep going up in cost. Then finally, All at Four. In All at Four, they did a medium amount of test controls. So once again, it's an All at Two. They must have said, well, our preliminary understanding of control risk is less than 100%. They went in and did extensive analytical procedures. My guess is this is not as good an audit client as an All at Two. Even though in All at Two, we still did the same medium test controls, the same extensive analytical procedures. Here's how I know that Audit Client 4 has more problems, more misstatements. Because the auditor saw these, once they got in there and they said, ooh, we've got to do extensive substantive tests of transactions, extensive tests of details, because this client definitely has problems. So Audit 4, not really the client we want, but we sometimes get, have no choices sometimes in life, and it's a more expensive audit because we did fewer of these cheaper tests of details. Well, we still did a lot of the cheaper tests of analytical procedures. That drove up the cost somewhat. What really drives up the cost of audit 4? Extensive substantive tests of transactions, extensive tests of details. So audit 4 is the most expensive client of all. So let me ask, do you have any questions about any of these? If I come back live, you won't see this on their screen. Questions? All righty. Let's look back at the notes. Oops. So just wanted for you to see the overall picture of that and to understand the overall story there. So we completed this first section. And any questions, anything you'd like to bring up? All right. I'll go back sharing my screen. So let's talk about what's in an audit program next, here in Roman numeral 2. It's going to be a checklist of steps that we do in the audit. So it's a very good guide to beginning auditors. It shows them what they need to do. And that's why an audit, one of the main reasons why audits are very good training for new accountants. They really are. So auditing experience, very, very valuable out there. And just very simple here about an audit program. There are phases in it. They normally include the following. First of all, procedures to obtain an understanding of internal control. We do those very early. And your book has tests of transactions. In other words, both test controls and substantive tests of transactions. But generally, even earlier than those, we do most analytical procedures. So that's why I say the bulk may be performed earlier, very early in the audit, because we want to know where problems are. Some again performed at the end of the audit, just to make sure things are still on target since some time has gone by. But what we try to do is to save tests of details in most areas of the audit until we've done these other audit procedures, these other audit tests. Because tests of details being the most expensive type of test, we're hoping that we save on the amount of tests of details we've got to do because of good results from the earlier audit tests. So if we get good results from the earlier audit tests, for example, we will not need to confirm as many accounts receivable. Poor results on the earlier audit tests, we would confirm more accounts receivable. Once again, accounts receivable, confirming them being a test of detail. And in your book, to let you know, figures 13.4 through 13.8 may or may not be of help to you. If they are, that's great. If not, that's okay too. So what I would like to cover, though, in more detail, will be an overview of the audit. And we'll see this on page 430, figure 13.9. And this here, if I pull this up, on page 430. We'll summary the audit process. And we'll see that phase 1 of the audit is to plan and design an audit approach. We've seen everything here, but I will walk you through this in a moment. And then kind of overviewing this, phase 2, which we've seen as well, will perform test controls and substantive tests of transactions. And then phase 3 will perform substantive analytical procedures, again, substantive being redundant there. Analytical procedures are automatically substantive. It's rather like saying ink pen or codfish or pen number, but we'll see what's in here. We'll perform analytical procedures and tests of details. And then phase 4 will complete the audit and issue an audit report. These things we will discuss in chapter 24. So let me concentrate here on phase 1. I will take a look at what's in my notes, and then I will come back here to the book. So here with this phase, plan, design, audit approach. Well, it involves obtaining an understanding of internal control of the client. Again, we've seen all these. We'll obtain background information, which we've done. We'll obtain information about legal obligations, which we've covered as well. We'll conduct analytical procedures and procedures to obtain an understanding of internal control. And we'll make a preliminary assessment of control risk, and also a preliminary assessment of the other variables in the audit risk model. Acceptable audit risk, also internal control, and materiality, all of which we've seen. So let's see a few more details here in the book about that. So we accepted the audit client and we performed initial planning. We did that several chapters ago. We understood the client's business and industry. We did some preliminary analytical procedures, or actually we do most here. And we also set preliminary judgment about materiality and performance materiality, which we did a few chapters back. Then we also brainstorm, we identify any significant risks due to fraud or error. And then as we continue assessing risk, we'll assess inherent risk of each account. We know once again as the risk that the account has a material error in it, assuming no internal control. Then we'll understand internal control. We'll assess control risk. So that is referring specifically to making a preliminary assessment of control risk. And this says finalize the overall audit strategy and audit plan. It's always subject to change, but we can develop a pretty good audit strategy, pretty good audit plan at this point, because we know how good or how bad this client may be. In other words, do they have, we think, fewer misstatements or more misstatements? Now with phase 2, once again, let me come back to my notes. I will come back to the book. So with phase 2, here in B in my notes, we'll do test controls and we'll do substantive tests of transactions. So we know the test controls will determine the effectiveness of the controls identified in the first phase to allow a final assessment of control risk. So here's where that final assessment will come in. And then substantive tests of transactions may also provide some information about the effectiveness of controls, but they're mainly there to serve to provide evidence on the monetary correctness of individual transactions. So again, substantive test transactions, we're looking at dollar amounts. Both types of tests allow the auditor to determine the extent of the remaining substantive tests. Again, if we get good results on the earlier tests, fewer substantive tests. Poor results on the earlier audit tests, more substantive tests. And these may even be performed before fiscal year end if the auditor is confident the internal control is good. For example, let's say that we test internal control as of October 31st. So on Halloween, things look good. We have a client with the December 31st fiscal year end. So we tested 2 months early. That's referred to as testing on an interim period or interim date. That's okay, because for a good client, if they have good internal control as of Halloween, they will still have good internal control as of December 31st. In fact, that moves it up out of busy season for us, and we might even give them a little break in price. So let's see these portrayed in the book in this flowchart. And the next thing we have is a diamond, which in flowcharting symbols is referred to as a decision to make. So the decision is, do we plan to reduce the assessed level of control risk? In other words, below the default value of 100% or not? If the answer is yes, we will perform test controls. If the answer is no, we'll skip right toward performing substantive tests of transactions and performing a very extensive amount of them, by the way. So they have a little note here, a little asterisk beside test controls. If we have a publicly traded client, that footnote says we must test controls. Privately held one, not necessarily. So in most cases, we will say the control risk is less than 100%, or I should say our preliminary assessment of control risk is less than 100%. This is referring to the preliminary assessment of control risk. If it's below 100%, yes, we will do test controls to prove it. If the answer is no, it will be 100%. We will skip right toward performing substantive tests of transactions. Again, an extensive amount of them. And then we will assess the likelihood of misstatements in the financial statements. So what is the risk of material misstatement? Referring back to the audit risk model. Then we'll have phase 3. Perform substantive analytical procedures, well, again, redundant, and tests of details and balances. Let me come to the book first. To my notes first, then back to the book. So here in C, that's where we have Roman numeral 3. We'll perform analytical procedures and tests of details. And as we stated above, the bulk of analytical procedures are usually performed early in the audit. Even though the textbook may lead you to believe otherwise, they make it sound like we wait. But this is because the results of analytical procedures partly determine the extent of the other tests, especially tests of details. So we're hoping for good results from analytical procedures. We hope that we save in the amount of other audit tests we must do, and especially tests of details because they're the most expensive. And most tests of details are usually done before fiscal year end, as we know. Usually done after fiscal year end. So we would confirm most accounts receivable after December 31st. But analytical procedures could be performed then. So if analytical procedures check out as of Halloween, they still would as of December 31st for a good client. And later chapters will discuss some tests of details which could be moved up to interim dates, like Halloween, to balance the auditor's workload. So if we confirm accounts receivable as of Halloween and they check out, they should still check out at fiscal year end of December 31st. But just to let you know, the moving up audit test to interim dates requires the client to have good internal control and low inherent risk and control risk. So again, we have a good client. Otherwise, the audit test will have to be performed closer to fiscal year end. So the worse the audit client is, the closer to fiscal year end, we've got to perform audit tests. Now, let's see this here in the book. They've got a flowcharting symbol that's not a standard one. It looks like a 3-story building with an attic and a pitched roof. Okay. So they're trying to say here, with this risk of material misstatement in the financials, is it low? Is it medium? Is it high or unknown? In that case, we assume a worst case scenario of high. Well, the higher it is, the more of these tests we must do. So we would do more analytical procedures if there's a high risk of material misstatement, because this client probably has some misstatements. Perform tests of key items. Well, that just means we're focusing on important items. But perform additional tests of details and balances. So a client with high risk of material misstatement, a lot of tests of details, like a large sample of accounts receivable confirmed. A client with low risk of material misstatement, again, fewer accounts receivable confirmations sent out. So again, kind of a strange flowchart example there. Well, then phase 4, complete the audit and issue an audit report. I just have in the notes more about this in chapter 24. So these things we'll see in chapter 24 next week. We'll perform some additional tests for presentation and disclosure, making sure everything is presented and disclosed in the financials properly, including footnote disclosure. We'll accumulate final evidence, wrap up loose ends. We'll evaluate the results. So are the client's financial statements fairly stated in accordance with GAAP or not? We'll issue the audit report. So is it clean? Is it qualified? Is it a disclaimer? Is it adverse? And we'll communicate everything we should with the audit committee and with management. So again, to those charged with governance. So those we'll see in chapter 24. So that concludes chapter 13. What questions do you have on it? Comments, anything I can help with? Okay, thank you, Lois.
Is that homework still due on this Saturday for the 13th?
Oh, actually, no. I will change that on my accounting lab. Thanks, Julie, for catching that. I'll go in after we're done. Yeah, as always, if you see something like on my accounting lab that you have a question about, let me know. And Julie's comment was very good that way. She caught the deadline, I corrected. Anything else so far? All right. Well, the other thing we have to do tonight is just a little bit of homework from chapter 13. I'm sorry, chapter 11. By the way, chapter 13, chapter 11, both subsections of the Internal Revenue Code relating to bankruptcy. So let me go ahead and share my screen once again. Chapter 11 homework. Well, the first part of chapter 11 homework, as always, pertains to review questions. Most of those are pretty basic, I think, but if you have any questions with review questions, let me know now. Alrighty. And then the only other thing we had from chapter 11, the first set of multiple choice questions from CPA exam. And I should say that I had number 21 on the syllabus, but I really need to take that off because it pertains to AIS. Again, with chapter 11, you did not need to do these on my accounting lab. So here with number 20, that's the only thing to do. General questions about internal control, and as always, we choose the best response. So first of all, on A, which of the following would not be considered an inherent limitation of the potential effectiveness of an entity's internal control structure? So as we think about inherent limitations, what is something about internal control that we can't get rid of, no matter how good an audit client we are? So what that would be, in this case, number 1, incompatible duties. We're saying that we did not segregate duties as we should. As an audit client, we are responsible for doing so. We can help this. The other 3 we cannot help. There are inherent limitations of internal control. For example, management override. Management can always override internal control by taking advantage of their position. So that's not it. Number 3, mistakes in judgment. Those can always occur too. So another inherent limitation. Or number 4, collusion among employees. even though we have enough employees to segregate duties, well, employees decide to get together and collude. So, for example, one who has custody of cash will collude with the other employee who has record-keeping responsibility for cash. And they get together, they say, okay, you, the employee with custody of cash, steal some. And then I, the employee who keeps the books for cash, or who does accounting for cash, that is, will cover it up in the books. That's always an inherent limitation of internal control. Then B, the actions, policies, and procedures reflect the overall attitude of management, directors, and owners of an entity about internal control relate to which of the following internal control components. And the answer is that that's going to be for number 3, risk assessment. That's one thing that we saw in the notes. And then, as we look at C, vendor account reconciliations are performed by 3 clerks in the accounts payable department on Friday of each week. So they're looking here at type internal verification. They're checking everything over and making sure that things went right. A vendor, by the way, is a seller to us. So we're talking about an account payable here. So they're reconciling their payables on Friday of each week. Again, more about that in the second auditing course. But the accounts payable supervisor reviews the completed reconciliations the following Monday to make sure they've been complete. So that part is also internal verification. It's rather like internal verification of the internal verification. And the work performed by the supervisor is an example of which COSO component. So that is number 1, a control activity, because the work performed by that supervisor is a part of segregation of duties and very, very necessary to do. Once again, number 21, I have it in the syllabus, but that's not something you need to do. And you will not be doing chapter 11 homework on my accounting lab anyway. So what questions do you have there on chapter 11 homework? A little bit that there is. Or questions, comments about anything else for that matter. All righty, so looks like everything's going well. Glad to hear it. And as always, whenever you have any questions and comments, you let me know. Always more than happy to help. Other than that, that's what I have for you tonight. And I will be posting this recording on YouTube, and I will send you a link. So in case you want to review anything, you have it there. And those who couldn't attend will also have a link there, so they're up to date. So other than that, have a great evening and look forward to seeing you virtually next week. I'll be in touch before then. Thank you.
Have a good night. Thank you so much.
Thank you. Have a good night too.
Have a good night. Bye-bye.
Thanks. Bye-bye.